Which way are interest rates headed? The current inflation cycle has been in motion for more than 2 years. The Federal Reserve has raised interest rates 10 times in the last 16 months. You'd think by now there would be some clarity about where monetary policy is headed, but there isn't, not even, it seems, among members of the Federal Reserve. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe and we'll keep you in the know. The economy is sending all kinds of messages these days. On one hand, unemployment remains near 50-year lows, and consumer spending is still resilient. On the other hand, manufacturing indexes are showing signs of contraction. The $20 trillion commercial real estate industry looks vulnerable, and banking system strength is an ongoing concern. The mixed signals have revealed a crack at the Federal Reserve, separating hawks from doves on the matter of how to proceed with monetary policy. One view is that the central bank should be more dovish in its handling of rates going forward. The other suggests that the Fed should be more hawkish and keep raising rates until inflation is back down to the 2% target level. The dovish case says that while unemployment and consumer spending numbers aren't suggesting recession, manufacturing and commercial real estate are. There's another consideration as well, that potential fragility in the financial system is being exposed by recent banking events. Some central bankers, including Fed Chair Jerome Powell, have expressed concerns that higher interest rates could place greater pressure on the rate-sensitive government securities held by financial institutions. According to the Wall Street Journal, Fed regulators right now are keeping a close watch on up to 30 banks that they consider to be vulnerable. After the central bank paused rate hikes 2 weeks ago, Powell indicated that possible stress in the banking system is a monetary policy consideration of his. Powell recently suggested a wait-and-see approach to interest rates is appropriate, saying, "We don't know the full extent of the consequences of the banking turmoil that we've seen." Fed Governor Christopher Waller doesn't agree. During a recent public appearance in Oslo, Norway, Waller said, "The Fed's job is to use monetary policy to achieve its dual mandate, and right now that means raising rates to fight inflation. It is the job of bank leaders to deal with interest rate risk. I do not support altering the stance of monetary policy over worries of ineffectual management at a few banks. And if you need any more evidence that Fed officials don't exactly see eye to eye on policy right now, look no further than the central bank's most recent summary of economic projections. At the same time Fed officials decided to pause rate hikes, they also revealed a so-called consensus opinion that interest rates will be raised 2 more times this year. But the individual projections reveal only half of the 18 policymakers actually said that's what should happen. As for the other half, each of their projections range from no additional increases to 4 more increases this year. Rate projections for the next 2 calendar years suggest even less agreement. According to the summary, policymakers' 2024 rate projections range from 3.6% to 5.9%. For 2025, projections range from as low as 2.4% to as high as 5.6%. If you're scratching your head these days wondering what the future holds for interest rates, just remember this. Federal Reserve officials, the very people in charge of determining where rates will be, seem to be doing the same thing. That's why I suggest you take the time to learn more about what's really going on in the economy by attending our exclusive one-on-one web conference at AugustaPreciousMetals.com/webconference.